All right, welcome to the Explainer. Today, we're cracking open one of the most volatile and, frankly, most critical ETFs in the entire financial sector. This thing is right at the heart of America's banking system, and, it was basically ground zero for the biggest banking crisis we've seen since 2008.
So let's just dive right in. We're talking about the Regional Banking ETF, ticker symbol KRE. Now, what if I told you that most investors who buy this thing don't really truly grasp what's going on under the hood? Because, you see, KRE isn't just some boring basket of bank stocks. No. It's a very specific high-octane machine. It has this unique design that can create absolutely explosive returns on the good times and just gut-wrenching losses when things go bad.
Okay, so to really get carry, you kind of have to forget everything you know about a standard ETF, like one that tracks the S&P 500. The secret here isn't what it owns, but how it owns it. The magic and the danger, it's all in the structure.
Think about most financial ETFs, like XLF, for example. They're what we call market cap weighted. It's simple. The giants, like JP Morgan and Berkshire Hathaway, they make up a huge slice of the pie. But KRE is totally different. It's equal weight. It holds about 150 smaller regional banks, and here's the key part. Every single one of them gets an equal seat at the table.
So, what does equal weighting actually mean in practice? Well, it means a tiny little bank in Texas has the exact same power to move this ETF's price as some super regional bank with hundreds of branches. Size just doesn't matter here. Every single stock pulls the same weight. And this one specific design choice, it has two massive consequences. On the upside, right? If a handful of those smaller banks just knock it out of the park one year, they can totally supercharge KRE's returns. It can blow past the giants. But the downside is pretty severe. If a few of those same small banks get into trouble, they drag the entire fund down with them. There's no JP Morgan around to cushion the blow. And this unique structure has led to a history of just wild performance swings. Seriously, KRE is not an ETF for the faint of heart. Its story is one of incredible booms and, well, pretty devastating busts.
Let's look at the good times first. In years where the economy was really humming along and conditions were just perfect for banks, KRE put up some staggering numbers. I'm talking up over 47% in 2013, 35% in 2016, and another 39% in 2021. In those years, its equal weight structure was an absolute rocket engine.
And then came March 2023. When Silicon Valley Bank collapsed, it set off the biggest U.S. bank failure since the financial crisis. And KRE, with its portfolio of 150 equally weighted regional banks, was sitting right at the epicenter of all that panic. The damage was immediate and it was severe. For the full year of 2023, KRE ended up down over 7.5%. Meanwhile, the standard financial ETF, XLF, which actually benefited from the chaos as money flowed to the giants, was up 12%. I mean, that is a staggering performance gap of almost 20% in a single year. It's the perfect and painful illustration of KRE's structural risk. So, okay, we know the structure itself creates this volatility. But what are the outside factors that KRE is so incredibly sensitive to? It really all boils down to two huge risks that every single KRE investor has to understand.
The first one, and honestly the most important, is the yield curve. For a regional bank whose whole business is basically borrowing short-term and lending long-term, the shape of this curve is, well, it's everything. It can be a massive tailwind or an absolutely crushing headwind. You see, when the curve is steep, that just means long-term rates are much higher than short-term rates. Banks make a ton of money on that spread. That's when you see those huge return years for KRE. But when the curve is flat, or even inverted, like it was right before the SVB crisis, bank profit margins just get squeezed down to almost nothing, and that puts immense pressure on the whole sector. All right, the second major risk is commercial real estate, or CRE. Regional banks are, and this is no exaggeration, the backbone of commercial real estate lending in America. They hold nearly half of all the outstanding CRE loans. That's a much higher concentration than you'll find at the megabanks. And right now, that is a huge problem, especially in the office building sector where post-pandemic vacancy rates are still hanging out above 30%. As trillions of dollars in these loans start coming due, they have to be refinanced at much higher interest rates. This creates the potential for a wave of defaults and major losses for the banks holding them, and those are the exact banks that fill up the KRE portfolio. Now, beyond all those market risks, there's another crucial factor that a lot of investors just overlook: the fee. And over the long term, this hidden cost can be absolutely devastating to your returns. KRE charges an expense ratio of 0.35% a year. Now, that might not sound like a lot, but just compare it to XLF, which charges a tiny 0.08%. That means KRE is more than 4 times as expensive as its main competitor. So what does that look like in real dollars? Let's say you invest $1 million. Over 30 years, that seemingly small fee difference would cost you an extra $177,000. Gone. Just for the privilege of owning KRE instead of XLF. That is a massive, massive performance drag. Okay, so we've looked at the unique structure, the crazy history of extremes, the major risks, and those hidden costs. So what does this all mean for you? How do you actually decide if KRE belongs in your portfolio? Well, KRE is really for a very specific type of investor. It's a tactical tool. It's for someone making a high conviction bet that the economy is about to get a lot better and the yield curve is about to steepen. It is absolutely not for a long-term buy and hold investor who's looking for stable, low-cost exposure to the financial sector. The best way to think about it is like this. KRE is a scalpel, not a Swiss Army knife. It's designed for a very specific job at a very specific time, and if you use it incorrectly, it can do a whole lot of damage. It is not a core holding. And this really is the best way to frame it. KRE is not an investment that you make for the long haul. It's a position you take for a specific economic cycle. It's a high-conviction, high-volatility tool for an explicit tactical bet. Knowing that difference, well, that's the whole key. You know, understanding the intricate details of what you actually own, that's the first step to becoming a smarter investor. For more deep dives just like this one, make sure you subscribe to The Explainer. Thanks for watching.